All right, got the recording going. We are live and welcome everyone to day five of the Crypto Profit Accelerator slash online summit, whatever you want to call it. It's the same content either way. And we have covered a lot of ground so far. And today we get into the actual strategy. Okay. This is the stuff that everybody wants on day one. This is the stuff that everybody says, hey, Brandon, just like give me a strategy. It's fine. Like, yeah, I'll take it from there. Even to the point where some people want to skip over this and just go, they just want to get straight to the tactics and the tools, right? Principles, frameworks, strategies, tactics, tools. We got that layered hierarchy. And most people want to just get the tactics and the tools, okay? And that's reflected by when someone asks you the question, well, hey, what should I buy? Well, I don't know. I don't know what your starting capital is. I don't know what your time horizon is. I don't know what your risk tolerance is. There's all these factors that go into play, but still people insist on, well, just tell me what coin to buy. And they want to give up responsibility to someone else, which, as we saw in the day on security and self-custody and avoiding scams, that's what crypto is all about, is taking radical responsibility for yourself, for your self-custody, for your entire portfolio and applying the types of frameworks and strategies that we're going to be going through for this session. Okay, so I know that's a review. I know I've said that before, but it bears repeating because inevitably, for you, for me, for anyone, for even for the mastermind members and the inner circle members, you will be tempted to go back to the most rudimentary form of this pursuit, which is just tell me what coin to buy, okay? And you read articles where someone goes, "Oh my gosh, I put 10,000 into Dogecoin and now it's 10 million." Okay, cool. Yeah, those happen, but they're extremely rare and it doesn't happen to everybody. So we read about the few anomalies and we think that's going to be me, that's going to be everybody. And we're saying let's rather slow down and take a hedged approach. Okay. And I'm going to keep mentioning this, the hedged approach, because that's what this strategy is. This strategy is not chase the maximum possible upside. This strategy is not 800% a year guaranteed. No, it's none of that. Okay. And we're going to be walking through the patient investor calculator today as well, just so you can see as an illustration, not as a guarantee of returns, but as an illustration of how big your portfolio can grow with returns that most people would kind of scoff at. Okay, so let me share my screen and we will dig right into the content here today. So there's the patient investor calculator. We'll get to that here in a second. And oh, we'll also, if I don't do this, remind me, we'll also check in on that demo position that I opened on Monday. I'm going to show you it's actually doing just as we expected it to. So it's right on track. All right, remember, we've been talking about 50 to 100% APR. This is a reasonable expectation, not guarantee, right? But it's okay to have reasonable expectations. Reasonable expectations for potential yield on blue chip pairs. Okay, and remember the pair that we did the demo on was a pair of Solana paired with USDC. And we talked a little bit about how, look, if you took a slice of time in the past, a 12-month time frame, and you bought Solana at around, 160, and then here we are a year, well, it's a little higher now, but about a year later, and it's around the same-ish price, you would go, great, I bought an investment, I bought Solana, I waited an entire year, nothing happened because it went a little bit up, a little bit down, a little bit up, a little bit down, all over the place, just nothing. However, if you had paired Solana with USDC, even in that same 12-month time frame, you would have ended up with 112% return based on the average daily APR over the course of that year. Okay. Now we can always look in retrospect and go, well, yeah, Brandon, I could say, oh, if I had bought Bitcoin 10 years ago, look how much money I could make. Yeah, I'll grant you that. Like looking backwards in time is always easier because you already know what happened. So the question though is when we're looking forward in time, what should we do? How do we set ourselves up to account for multiple possibilities? And when I say multiple possibilities, I mean multiple very likely possibilities. So we go, hey, what is Sol going to do in the next 3 months? I don't know. What is Sol going to do in the next 9 months? I don't know. I would expect it to do things that Solana does. It goes up, it goes down, it goes sideways. It might and probably will break its all-time high at some point and then come right back down and kind of form a more like steady pattern. That could very well happen. Okay. So we're talking about how to set yourself up to account for all the multiple possibilities that could and very likely will happen. Because if I'm just buying and holding to sell for a profit, that's not necessarily bad, but I might buy Solana, I might wait a while, I might sell, and I go, hey, cool, I get a profit. That's great. Now, if we have an opportunity to add to that, 50 to 100% APR, why wouldn't I take that opportunity? Because remember, this reasonable expectation, this is just the yield that is generated from you becoming a liquidity provider and collecting a portion of the trading fees that are generated by that effort of you being a liquidity provider. And that's really not that much effort at all when it all comes down to it. And, we talked about you're providing real value to an ecosystem. You are making someone else's crypto platform safer, faster, more reliable, and you're providing deeper liquidity, which makes that platform less volatile, which makes it more attractive to traders, which is what a decentralized exchange platform wants, is more trade volume because that's their profit model. Now, you're getting paid a portion of the trading fees generated because you are providing value. So it's compensation for a legitimate transaction versus money out of thin air, which is typically what we find in the crypto world. Now, before we get into the strategy, let's just take a look at the power of this number, okay? And you'll often hear me talk about this. Look, even if all you got was the 50 to 100% per year APR, you are still outperforming every other asset class by a massive margin. So, by way of illustration, what I'm going to do is say, let's just split the difference and call it 75%. Okay. Because we could come up with 100 different possibilities. That's not the point of this. Again, these aren't guarantees. This is just one illustration of one possibility to say, hey, if I start with, and I'm just going to put in a number 10,000, okay? Doesn't matter what, we could play with that number too, but if I'm going to start with 10,000 and I get an annual return rate of 75%, that's what we're showing here. Then after 1 year, and I'm just going to do annual compounding, okay? Again, we're going like super conservative estimate. If I only got the 50 to 100%, my assets don't appreciate, which they likely will. If that's all I get and I only compound once a year, which typically you would compound at least quarterly, if not monthly, or some people do it weekly, depending on what they've got. But if I'm only compounding annually, this is a very conservative estimate, reasonable expectation. Great. At the end of 1 year, I've got 17,500 total yield earned. That's the 75% right there. I go, great. Now let's extend this out because everybody wants all of the returns now. But the reality is, if you're willing to just stay in this game, and again, once you get set up low maintenance, you don't really have to do much. In fact, as we talked about yesterday, more often than not, almost every time doing more actually hurts you. So you go, oh, if I can get 75% with this amount of effort, I'll do twice the effort and get twice the return. Doesn't work that way. Okay. So now let's just extrapolate this out and say, oh, what if I waited 2 years, 3 years, 4 years, 5 years? I go, oh my gosh, 164,000. That is a 16x return if I'm willing to wait. All right. Now, but the power of compounding, even just annual compounding, the reality is it doesn't start to get really good until about year 8 through 12-ish or so. So we can pull this all the way out. Let's go to 8 years. I'm at 879,000. And again, you go, Well, I want 20 million, Brandon. Well, okay, but you started with 10,000. This is a killer return, especially if you account for the fact that if I was doing like the S&P 500 or something like that and getting 8 to 12% a year, well, this only go 20 is the lowest. Even at a 20% annual return, you're still doing pretty well compared to an 8 to 12% annual return. So then I'm going to pull this back up to the 75-ish percent, 75.4. And I'm gonna put this all the way to the 10 years. Now, we could go to 12 years and we could go beyond, but the part of the point here is the numbers just get ludicrous when you do that. Even at 10 years, 75% annual compounding, the 10,000 becomes 2.75 million. Okay. And then you can play with these numbers. You go, well, what if I started, Brandon? What if I started with 25,000? Great. 10 years later, there's your total amount. Okay. And again, it's just an illustration, it's just an estimate based on this number right here. So let's go back to our conservative estimate. I start with 10,000, leave it in for 10 years, compounding annually. But again, this is only accounting for one layer of profit opportunity. Okay. So 10,000 to 2.7 million, one layer of profit opportunity. We are going to be talking about multiple layers of, I call it profit opportunity because you'll see there are many different ways to allocate the yield to participate in this strategy. And remember when we talked about the barbell analogy, right? The bimodal strategy, we have the safe and reliable over here on this side. And in our context, is that showing up? There we go. Reliable on this side. And in our context in crypto, that will be our blue chip pairs. And then over here, we have things with a higher possible upside. And you would put a smaller portion of your portfolio and your yield on that side. But that's the point, is if the possible upside is that much greater on something like this, then it's okay. Sorry, this is not streaming. There it goes. It's not streaming from my tablet, but it's there. Okay, I think there was a Q&A. Is this how often is there a need to change in blue chip pair? We'll get to all of that and then we'll handle some of these questions at the end. Okay, so here's what I'm going to do. I'm going to take the barbell strategy, reliable and upside, and the first layer I'm going to put here. This will be my LP pairs. Okay, there we go. Now I'm going to use, for example, I'm going to say Sol USDC because that's the one we built. Okay, this blue chip pair category, this could be any number of different assets. It might be wrapped Bitcoin in a stable coin. It might be BNB paired with a stable coin. It might be, you can even pair XRP with BNB on the Binance Smart Chain on PancakeSwap. Okay, it could be any number of pairs. ETH, USDC, maybe Pendle, maybe Curve, maybe Link, Chainlink. For a while, I was running an ETH Link pair, which was returning over 70% APR, which is killer. You go, gosh, two blue chip assets like ETH and Link. I'll take APR over 70% APR on those any day. So we've got our LP pairs, any number of different possibilities there. And these generate for us some kind of yield. Now, when we are participating in V3 concentrated liquidity, we are getting paid in the form of the assets that we are pairing and providing. So your initial yield will come to you in the form of Solana, and it will come to you in the form of USDC. But again, it's always going to be the assets that you're providing. So if you just love Bitcoin and Ethereum only, and you're like, I just want to accumulate as much Bitcoin and Ethereum as possible, great. Create a Bitcoin Ethereum pair, wrapped Bitcoin, wrapped Ethereum, and then you'll probably average more like 25 to 30% APR on a pair like that, just because it's so popular. There's so many people providing liquidity for that pair. But the trade volume is also super high, and those are two of the highest market cap and most reliable assets at this point. So you can expect a slightly lower APR, but you'll also be accumulating from the yield more ETH, more Bitcoin. And then in that example, you might just hodl that. You might just say, you know what? I'm just going to create a whole separate portfolio over here, and I'm just going to hold that extra Bitcoin, Ethereum, Solana, USDC, whatever it might be, and it's just going to be hanging out there and doing its thing. And I'm going to wait and just have patience and let it do its thing. Apologize, this is still not updating in real time, but that says hodl with an arrow. The other option, other than just holding it forever. Oh, there we go. Sorry, give me 1 second here. I'm gonna reset this. All right, and we're back. Technical difficulties, but there we go. Okay, so other than just holding these assets, now I can add another layer. Okay, and here's where you have options. I'm going to first give you the most basic option. And the most basic option is to take that yield, roll it back into your LP pair, and just keep it going. So this would be remember our potato farm, right? I have the land, I grow some potatoes, I sell the potatoes, I buy more land, I put it right back over here. Okay. So this is the simplest loop that you get, and you still get multiple layers because you have your base assets, you have the yield, and then you have the compounding factor. So, all right. That's pretty good. Or and this is in like a bull market environment, this is one of the I think the better play is where we say, here's my LP pair. That's going to get me some kind of yield. And then that yield, I'm going to build a whole separate portfolio called my bull run portfolio. So because I still have the base assets over here, I'm still getting base assets. And the possible long-term appreciation of those base assets. I'm still getting the yield from those base assets. I'm still getting appreciation on the yield, right? Because the yield in itself, unless I take all the yield in stablecoin, the yield itself can also be converted to assets that are variable and can grow over time. And then I'm also going to get whatever else I buy. I'm just going to call this other assets. So now I'm going to take, in this example, I'm going to take my SOL and USDC, and I say, all right, I have a few macro beliefs in a few assets. It might be Bitcoin, it might be Ethereum, it might be Guard, it might be Solana, it might be BNB, whatever it is. I'm going to convert that into some of these other assets, and I'm building a portfolio that is pure upside. Okay. Meaning everything I put in here, meaning this is just what I convert the yield into. Everything that I put in here, even if it loses value over time, I'm like, well, that's okay because it was all house money. It was just what I got from the yield, from the trading fees that I generated. But in all likelihood, depending on what I'm invested in, that will long term also grow and appreciate over time. So that 50 to 100% that we talked about, that's just the yield. If you convert that yield into other variable assets, that 50 to 100% itself has the potential to be much more than that in effect. Because if I get 100% return, just yield, so I put in 10,000, I get 10,000 in yield, but then that yield also doubles in value. Well, now I actually got 20,000 off the initial 10, and that's 200%. So that's what I'm talking about here is the pure upside is layered on top of the yield that you're generating. So what some people do is they just generate yield and then they just pull it out as cash and they spend it. That's fine, nothing wrong with that. It's just that that won't allow for long-term compounding and it won't allow for further growth of those assets that you're generating that form the basis for the yield. So the pure upside here, this is where I might say, hey, you know what? Just from my yield, okay, only the yield, I might take, and again, this is just one possibility, I might take 80% of that and put it in blue chips. And for bull run portfolio, I'm actually going to leave those unpaired. Okay. So this is again hedged, meaning I've got pairs over here generating yield. And then the yield they generate, I'm actually going to leave those unpaired because there is a little bit higher potential total upside there. So now I'm hedged. Now I've got a barbell now. So I've got the reliable over here, I've got the better upside over here. So I might do 80% blue chips and 20%, I'm just going to say meme coins, but this would be, hey, out of a chunk of the yield that I generate, I'm going to go buy some Dogecoin. I'm going to go buy some Pepe the Froggy. I'm going to go buy Moodang the baby hippo. And you hear me bash on those projects, but the reality is they can, they do carry the potential to occupy that upside part of your bimodal strategy, your barbell. But in my opinion, I would only take those plays with a portion of the pure upside bit of my portfolio. Because if the return truly is asymmetric to the upside, this is what we were talking about yesterday. I don't take the same amount of risk for more upside. I go, hey, if the upside asymmetry to the upside is 20x possibility, then I can bet much, much less on that. Now I have effectively lowered my risk portfolio. So we want, if we're going to talk about risk mitigation, one of the ways that I mitigate my risk is taking smaller bets from house money to asymmetry to the upside. Okay. That's a lot of fancy words. All it really means is, hey, I'm going to put a smaller amount on the riskier stuff, but even that small amount on the riskier bets, that's going to come from the yield that I generated from taking the reliable bets. And it's not as if there's no risk here. People always ask me, well, what's the risk on this kind of stuff, Brandon? And I would say, well, the risk is equivalent to holding crypto. So if you're going to hold Solana, that's a risk. In my opinion, it's not a very risky risk. It's actually a pretty good one. And but anything can happen, and we've seen this in crypto because they are technically they're like more speculative plays. The Ethereum Foundation could blow up tomorrow and the whole thing goes to zero. I don't think that's likely, especially based on like institutional adoption and some of these big things that are coming down the pipeline. But the point is, yeah, you got to just accept the fact that there is some risk associated with that. The same that there would be risk with any other asset class or investment that you take up. It's risk of just what could happen price wise, but it's also risk in terms of how much time does that thing take up and how much mind share does it occupy for you. Okay. So this gets kind of messy, but let's do a quick recap here. Okay. Because this is the base strategy. So I would say LP, blue chips. Now, some people will put the funny assets into this one. Can you do that? Of course you can. Do I recommend it personally? No way. So someone might say, Brandon, I want to make a fart coin soul pair because for a while that was paying out 5 to 7% a day. And I go, cool, do a fart coin soul pair, but don't put 20 grand in fart coin soul unless you've got a $10 million portfolio and you just want to play around. But take the smaller bet on a fart coin soul or a whatever kind of meme coin pair that you want to talk about and take the smaller bet. Bonk is another on the Solana network. Bonk is another meme coin that I'm like, I wouldn't put this is just me personally. I wouldn't put 20 grand in Bonk Solana. But if I had a couple thousand that I generated from a Sol USDC pair, I'd put that into silly Bonk Sol pair and just kind of see, roll the dice and see what happens. So we've got the LP pairs. This creates our yield. And then that yield will convert to the bull run portfolio. Then I can take a portion or all of anything that I've generated. I can pull that back over here and I can compound a portion or all of it right back into my base level pairs. So you can see how these things start to layer on top of each other. So I'm going to write down base assets. If you are a buy and hold, if you are a day trader, if you're any other approach, this is your layer. This is your profit opportunity is can I buy it low? Can I sell it a little bit higher and make a little money? And again, I would argue nothing wrong with that. But if you're in a position to add additional layers, why not? So now we're going to add just one layer at first. We're just going to add, I earn a yield. Okay. And let's say it's Sol in USDC. Well, half of that yield is USDC. That's just a stable coin. It just sits there. But if I convert that stable coin into some other variable asset, I have the potential, again, it's not a guarantee, but I have the potential of appreciation of the yield, which is just another layer. So I get paid, but then the thing that I'm getting paid in can also go up in value. In our real estate metaphor, it's like, okay, I own the property. I earn rental fees every month. I get paid in dollars. So that's just my dollars. In fact, it's losing value. But let's say someone wants to pay me in well, it could be a crypto, but just by way of metaphor, someone pays me in gold coins. All right. I go, okay, that gold coin, it might be worth whatever per ounce today, but then if I keep those gold coins, maybe they're worth double in a few years or 20% gain or whatever the point is there's a possibility of appreciation of the thing that your productive assets are generating. So this would be, if we use the potato metaphor, this would be if I yield potatoes and I go, hey, potatoes are only worth $3 a bushel or however you measure potatoes. They're only worth $3 a bushel today, but I think in 6 months they're going to be worth $4 a bushel and I hold on to it. And lo and behold, there's a potato shortage and the price of potatoes skyrockets and I sell the potatoes at twice what they were worth when I produced them. That's what this layer represents. Okay. So if I earn all of my yield and then I hold on to it or I do something else with it, it can potentially also go up in value, or I might just be accumulating it long term. And then we have the last one would be compounding. All right. And there are other, even more multi-layered strategies, but that's the kind of stuff we dig into in the mastermind, like one-on-one kind of stuff. What's appropriate for you? What's maybe not appropriate for you? This right here, for most people, this is where you'll get a vast majority of your gains is just sticking with these four layers of profit opportunity. Because we could talk about, well, I could take the yield and then I could stake it over here and then I can earn other assets and then I can sell those and do that. Like there's other possibilities. But again, in the interest of, hey, what's the simplest path forward other than buy Bitcoin and hold for 20 years? This is the simplest path forward because it works just on the mechanism of DeFi, which is the automated market makers, the liquidity pools. We went over all of that. That's why we did that first, because like the strategy kind of doesn't make sense unless you understand what the mechanisms are that are operating in the background. So 1, 2, 3, with the possibility of compounding. And that's it. And I'll just tell you ahead of time, if you go and try to do this, you'll be tempted to make it more complicated than it actually needs to be. Okay, it doesn't need to be complicated. It can be very, very simple. And tomorrow is when we get into tactics and tools. Okay, so we're going to take this because you go, okay, Brandon, I get it. Like at a from a high level, conceptually, this is not difficult to understand, right? It's one, two, three. It's base assets, generates yield, do something with the yield compound. Like that's not actually complicated. But then there's a bunch of button clicking that has to happen in order to create this strategy, in order to execute it, put it into play. All right. Now, before we jump into questions, we're going to check in on our pair. So we went over to Orca. Pull this up here. Give me a second to pull this up. Portfolio. There we go. Okay. Here we are. So we're back at Orca with our demo wallet. Remember, our initial position was about 60 bucks. And the first day it went down to like $58. And you go, you're losing money, Brandon. Well, look, here we are. I bounced back again. And I'm not counting on that gain, right? That's whatever that's a 5% gain on the base assets from growth, from appreciation. But tomorrow that could go back down to 55. And I go, that's okay because I'm not there is a version of this game where you do like really short-term positions. I'm not a super fan of that. I'm rather like get in a position that you can be in for a while and just like hold there and enjoy all the free yield that you're generating. And so I'm up a little bit today on this particular position, but again, I'm not counting on that because that fluctuates. That's just price action. It changes every day, every hour, every minute. Now the yield is what's important, and you'll see again, I've got half SOL, half USDC because that's what I've paired together. I'll zoom in on this a little bit. And you go again, gosh, Brandon, 67%, that seems pretty low. But I'm going to take that zero point 0.3, this over here, the zero point 0.3. I'm just going to go no compounding, just straight linear, zero point 0.3 times 365. I'm at 109.5% APR. And I think if I remember right, at one time it was a little bit higher. It was like 0.32 or something like that. When we first started, it was like 0.268. So you can see how even the daily APRs are going to fluctuate. But the point is, right now, where we're at, we're on track for somewhere in that 0.29, 0.3% daily APR on average. Now, my guess is as the market continues to heat up, we'll see an increase not only in price on the chart, but we'll also see an increase in trade volume, which is good. That's why bull runs are so fun, not only for the growth of the base assets, but also because there's massive influx of trade volume, and that bumps these yields up significantly. I've seen the SOL USDC pair, I've seen this as high as 1 and 2% daily APR. Now, that does not mean multiply 2% by 365, I'm going to get a 700 and something percent return over year. No, it's just saying, hey, some days it goes whoop, some days it comes back down. And over time, like I said, historically, I on the one pair, I got 112% for a whole year. And that was just playing it conservatively, acknowledging that, hey, I see this chart as for now anyway, I think it's going to move more or less sideways even though there's these ups and downs and ups and downs and ups and downs, I'm just going to ride that wave. Okay. So this pair, we'll check back on in on it on Saturday and Sunday. So remember, we've got 2 more days, Saturday and Sunday. We're going to talk tactics and tools and get down to the nitty gritty button clicking. But the point is that this pair, even though it does fluctuate like any pair will, over time, you'll still get a very not predictable, I'm going to say reliable return that will typically be in that range of 50 to 100%. And that's why it's a range because I'm like, I actually don't know what the overall return is going to be. But if we set these positions up with the 50 to 100% in mind, we can still play extremely conservatively by crypto standards and get a killer return compared to most other asset classes that are available to us. All right. I'll pause here because I think I saw a few questions pop up and we can start to address those. And we're a little bit ahead of schedule, so there's extra time for questions. Or if we finish early, we finish early, no big deal. We've still got plenty of time. We've got a couple of days to go through all the button clicking and setting things up. All right, so first one, how often is there a need to change in blue chip pairs? So I would say there's rarely a need to change blue chip pairs. But oftentimes, people will select a small collection of blue chip pairs. So, like if I was starting fresh today with 20,000 in capital, I probably wouldn't put the whole 20,000 into one pair unless I had some super special insider information about the asset that I was just like, I just believe in it so hard. I mean, well, okay, I take that back. You could do a like an Ethereum Bitcoin pair and put your entire portfolio into. I still wouldn't do that, but I'm saying like that it wouldn't be ludicrous or out of the question for a person to opt in for that approach. But most people will choose just a small collection, right? So you might have a little BNB, a little Solana, a little Ethereum, a little whatever, Bitcoin, and you pair those either with stable coins or other blue chip assets. And then you just kind of ride it out. So again, I wouldn't say there's a need to change. And I would argue that the fewer moves you make over time, the better off that you are. Remember, we talked about what's the article Nick mentioned yesterday when DCA beats God? Just meaning that, even if you could predict the tippy top and the deepest trenches, you're still better off just DCAing in over time. And fewer moves being better, like who has the best portfolio? Oh, the dead people have the best portfolio, or the people who forgot about it altogether because they just like left it there and let the market do its thing. Similar principle at play here. If you can put Solana, USDC, or whatever pair you're in, if you can just put it there and check on it, twice a month probably is going to be appropriate for a pair like that, you're going to be okay. Okay, in your example, you used Orca to create the LP pair. What do you think about using Camino instead of Orca? I've heard that Camino automatically compounds the yield back into the pair and also will rebalance the pair if it gets close to the outer range limits. Okay, Camino I've never heard of, so I cannot say one way or the other if that's a reliable platform. Tomorrow we're going to look at a platform called Crystal, which is, again, it's just a liquidity management platform that leverages other exchanges. It leverages the market makers of Uniswap and PancakeSwap and Radium and Aerodrome and some of these others. So that would be one that I feel comfortable recommending only to like again, it's crypto, wild things can happen, but I would say this is one of the tools that I'm using. And so I feel comfortable showing people that I'm using it because it's like, yeah, at this stage, based on everything that we know, these are the most reliable liquidity management platforms that are currently available. That could change in 6 to 12 months. Who knows? I mean, before Crystal came on the scene, it was pretty chunky to put all this stuff together. But yeah, we'll be taking a look at Crystal specifically. And yes, Crystal also has options to, I think you're talking about the auto rebalance feature. I actually don't recommend when people are starting out with this I don't recommend using auto rebalance. Automations, just again, as a principle, not just in crypto, automations should serve as you're automating a process that you already have mastered manually and all you're really trying to do is save yourself a little time in button clicking. Automations don't fill the gap of I just don't want to do it, right? That's like in any business, you would say delegate a process, not a problem. Same thing here with automations. Like we don't want to go, my problem is I'm bored of this and I just want to be lazy, so I'll turn on the automation. You'll get wrecked if you do that because what happens with auto rebalance, if you don't know how to set it up properly, there are small transaction fees associated with a rebalance. And if you're constantly rebalancing, you'll end up eating up a majority, if not all, of the yield just from the fees that you pay from rebalancing. As crazy as that sounds, I've seen it happen where someone goes, gosh, I made, 10,000 in yield, but I paid 9,500 because I rebalanced 3 times a day for the last month. And I go, yeah, that's because you had a little set the range ADD and you just are all over the place. that's why it's critical. And we'll talk a little bit about this tomorrow because we're getting in tactics, tools. Part of the tactic is setting your ranges, and the tools would be Crystal, Orca, whatever. But yes, setting your ranges is one of the variables that comes into play, and I would not recommend trying to auto rebalance when you're new to this. I would say take your time, learn the process, go through the struggle, go through the cognitive dissonance, and then come out on the other side. And then if you choose to use auto rebalance, you'll be in the driver's seat. It's one of those things, if you have to ask someone else, should I auto rebalance? If you're asking someone else if you should, the answer is definitely no. Manny, if I have assets in Coinbase, can I, and what is the process to transfer these to a DeFi exchange? Okay, good question. And we got to define terms here. So, Manny, you would not transfer to a DeFi exchange. You would transfer to a self-custodied wallet. Okay, and that would be the example we used was MetaMask and the Phantom wallet. Okay, there are many, but the point is you transfer the assets to an environment where you have self-custody and you are in control. Then it's the self-custodied wallet that interacts with the decentralized exchange. So the wallet is in effect your digital signature, permissionless validation. It's your digital signature saying, I grant permission for this particular smart contract, whether it's an exchange platform or liquidity management platform. You're granting that smart contract permissions to interact with your wallet and do things, pull assets out, put assets in, create pairs. Now, what really happens is when you create a pair, you get like a receipt, you get an NFT in your wallet, and you can actually transfer that NFT all over the place. And anyone who has that NFT, it's basically like the claim check for that liquidity position. So it's pretty cool once you get into it, what's really happening. But again, for the sake of simplicity, just know centralized exchange, send those assets to a self-custodied wallet. Self-custodied wallet interacts with the decentralized exchanges. Ken, I don't know what I should do to keep track of all my crypto activity for year-end tax reporting. How do you keep track of everything? Ken, this is the same question you asked before, and I don't mean to be rude, but I answered this. I will answer it again, but I would encourage you that after I answer it, that you go and like explore this on your own, because this is not something that you can farm out to someone else. Like you have to track everything tax-wise. There are tools, though, and Coinly is one of them spelled with a K. I believe it's coinly.io, Koinly.io. And that is a software that allows you to connect and import information and data transactions from your wallet, which are recorded on the blockchain. And then Coinly as a service will categorize and figure out all of those things for you. Now, notoriously, Coinly or any of these software tax reporting softwares, there will be gaps. None of them yet are 100% accurate. So you got to be mindful of that and know that you might have to go through and categorize a few things. So it'll take a little bit of button clicking on your part as well. And yeah, an accountant's not going to know how to do this. This is something that every individual has to take care of themselves. What you want to do, and Coinly does this as well, they produce the Form 8949 and the Schedule D. That's the form you give to your accountant because your CPA goes, oh, this looks familiar. I recognize this form. I do these all the time. All the stuff before that, either you do it on your own or you hire a business like Crypto Tax Made Easy, Matthew Walrath, and him and his team actually will categorize things for you. John, the yield will never be negative as this is fee-based, correct? John, that is correct. It will never be negative. A worst case scenario would be if you're farming silly meme coins that tank to zero, then your yield could potentially go to zero, but that's only if you convert all of your yield into something ultra high risk. As we just covered, I would never recommend taking all of your yield and go gambling with it. I would at most say take 20% of your yield if you want to get into funny, silly meme coins. Otherwise, you're either compounding or converting everything into bull run portfolio assets, which would be either assets that you have a macro belief in, things that you're connected to personally that you have an influence over, or just straight up blue chips. So that, yeah, the yield will always be a net positive, but keep in mind, base assets fluctuate. And this is what happens is human nature goes, remember, this is the $60 position that goes down to 58. What if that $60 position went down to 30 and you go, oh my God, I lost half my money. Yield farming doesn't work. It does work. It's just that you have to play it out over the long term and accept the fact that it's the market. The market goes up, the market goes down, the market goes sideways and all over the place. Okay. So once you accept that as the reality, you're able to say, okay, my base assets will fluctuate up and down. And yeah, there might come a point where they go up a lot. I go out of range. I remove liquidity at a gain. And then I also have the yield, which would be in that situation always a net positive. But yeah, it won't go negative. The valuation of your base assets could fluctuate. So if you get spooked, when like if Solana does a dip and you get spooked and you pull it out and then you sell everything and convert back to stablecoin, yes, then you would be realizing a slight loss, but the realization of that loss would only be because you didn't have the understanding of how the market fluctuates. And people do this, by the way. It's not like, oh, you're a rotten human if you do it. It's just that like sometimes people get spooked. They don't have the emotional wherewithal to like you be in the market. And in those situations, yeah, you might realize a loss, but that would be because of emotional volatility, not because of the mechanism of yield farming. Can you recap principles, frameworks, and strategy once more? Or share an email. Sorry, I'm not trying to be snarky here, but that's it's all on the replays. Like you can go back and watch the replay if you want a recap of those things. And I would actually encourage everybody to do that, even if you were attended live. Like go back, watch the replays. It's really, really good stuff. It's the kind of thing that you watch it once, it doesn't necessarily like really sink in. You got to go back and watch it a few times to really like integrate that perspective into how you approach investing. And again, it's things that you could apply to other categories of life, not just crypto investing as well. Okay, cool. Anthony, hi Brandon. When an LP goes out of range, what's your approach to rebalancing? That is what we're going to do tomorrow. That's tactics and tools. Today was all strategy, tomorrow's tactics and tools. But the general approach is you'll have a few options. One option is to leave it, let it come back in range. One option is to rebalance. And the other option would be to constantly monitor it and make micro adjustments. Okay. We'll talk a little bit about when each of those is most appropriate based on a few factors. But yes, we will absolutely cover that. And again, it'd be great if we could cover everything in a 1 hour session. It's just not realistic. So we'll get to that. Renata, do you recommend using an app to trade or just on desktop? My personal preference and recommendation is to do all of this stuff from a laptop or desktop, not from mobile. Only because mobile apps, especially for DeFi wallets, introduce a layer of vulnerability to you. Because if, worst case scenario, you lose the device, you lose your smartphone, then if someone knows what they're doing and they find that and they can somehow log into the app doesn't ask you to enter your full seed phrase every time you log into it. It's usually like, okay, enter the seed phrase, but then individual logins is just a password or sometimes just biometric data, or sometimes it's even just like save the password and you can just log in, which again, that's super vulnerable. So I wouldn't recommend ever doing that. Now, even as I say this, I promise you there's people listening on here live and on the replay that are going to go do it from mobile. Okay. Just know that I don't recommend that. I think it's a really bad idea only because of the introduction of the vulnerability. And it's one of those things where you go like, ah, Brandon, that'll never happen. No, but what if you do all of the things that introduce a fractional vulnerability? You go, I'm going to store my seed phrase on Google Drive. I'm going to, open up a mobile app and use it there. I'm going to, tell my friend about what I'm doing. I'm going to share all my whatever's online. Like if you keep doing little things like that, eventually one of them is going to screw you over completely. So I recommend always taking the most cautious path, whether that's storing your seed phrase in a lockbox or a safe or a safe deposit box at the bank or whatever the case may be, always take the action that has the highest levels of security that does not introduce unnecessary vulnerabilities. I still do not know how to access replays. Tried to search, but could not figure it out. I don't know who this is because it says anonymous, but you can email me and let me know. Well, first of all, tell me who this is, and then email me, and then I can send those to you. Okay, so what we've been doing is everyone who registered, we send out an email that says, "Hey, here's the replay from today." But inevitably, sometimes emails do funny things. They land in a spam box, they land in a promotion folder. One person told me they had to click the filter, I think it was in Gmail, they had to click the filter that says all rather than just I think what's the other one other than all emails, like priority emails or something like that, right? So you might have to click on your all filter, you might have to go to spam folder, you might have to go to promotions folder. They are there, we do send them out, but if you're still having trouble, let me know who you are, email me, and we'll figure it out. In the mastermind, do you explore more advanced strategies for different market cycle conditions? The short answer is yes. The longer answer is yes if. And the yes if depends on where you're at personally. So we take a learn by doing approach, but we also take an individualized approach. So is there like training and curriculum that applies to everyone? Yes, but most of the time, what people really want and need is the one-to-one mentorship. So you know what's best for you at any given time. Some people are at a place where they won't be ready for the advanced strategies for 3 months, 6 months, maybe a year or more. Some people will never be ready for them. That's okay. It's individualized. Some people jump in, they have a quick learning curve, and they start to implement more advanced stuff within the first couple of months. But again, it's completely conditional on the person. So again, short answer is yes, but the longer answer is depends on conditions and depends on the person. You spoke briefly about compounding daily, weekly, monthly, or annually. Wouldn't compounding daily give a much higher return? If so, why wouldn't someone always do that? Compounding daily, conceptually, yes, it could give you a higher return. But anytime you compound, because when you compound, you are harvesting, pairing, adding to a pair. Each of those moves carries a fractional transaction fee. Because remember, the mechanism that we're using is everybody's paying for a service. Everybody's paying for transactions, small transaction fees. That's trades, that's pairs, that's add liquidity, remove liquidity. There's tiny little bits. And if you're not careful, all of those bits start to add up. So let's say, for example, you have a $1,000 position and you want to compound it daily. Well, the daily yield on a $1,000 position at, 0.25% or whatever, it's not going to be a lot daily. Obviously, it adds up over time. But if you try to compound daily, you're going to spend the fees, you're going to spend the yield that you earned that day on the fees that it takes to compound it back in. So compounding daily can make sense if you have a high APR and you have a higher dollar value position. So if I had one position that was 50 grand, it might make sense to compound daily. I've seen, and this is not in the mastermind, but you can view other like what other people online are doing on Crystal. You can see the strategies section. There are people who will put, millions, like seven figures in a position of like, Bitcoin or Ethereum or, really reliable pairs. And they will either rebalance or compound like every hour or every twice an hour. Doesn't always make sense, but it can. It can work. But again, for the sake of simplicity, for most people, usually a weekly or month, even monthly compounding is appropriate because unless you want to be at your computer like constantly monitoring these things, which hey, some people do, but most of the people who are getting into this, it's because they want something super simple. They want something low maintenance that still generates really awesome returns. So if you want those three things, then typically around a monthly-ish compounding is most appropriate, just for the sake of simplicity. But you're right that compounding daily can have a place, but it again contingent on those variables. Thanks for sharing the strategy. Could you cover investor mastermind highlights, what will be done, how often, etc.? Yes. So, I mean, we'll go over this more in the next 2 days as well. But in a nutshell, the investor mastermind is number one, the community of other investors. Number two, there's a resource library that serves as a supplement to the one-on-ones. And then, of course, the main thing is the one-on-one mentorship. So when you join the mastermind, you get 2 years in the community and you get 6 months inside of that 2 years, 6 months of one-to-one mentorship, which is weekly meetings with your coach who's assigned to you, and as well as they'll give you like little interactive homework assignments that push the needle forward. And so in your case, Mr. or Mrs. Anonymous attendee, um, it would be factors like, oh man, I'm curious about daily compounding. Would this be appropriate for me? Well, we got to open up your portfolio. We got to figure it out. Maybe it is, maybe it isn't. It depends on a lot of things. So, all of these questions, these are great questions. Most of them are like highly individualized answers, though. And I'm trying to keep this training like more broad strokes that's applicable to everyone. So, ultimately, though, the outcomes of the mastermind are centered around the implementation of everything that we've been talking about, and then ongoing support and accountability. Brandon, it's Vladimir about accessing replies. I think you mean replays, not receiving those. Vladimir, do not please send me the email in a Zoom chat. Please email me separately. I think you might have already emailed me because I got like 20 emails. I'm gonna try to get back to everyone as I can. But I think I texted you as well. So check your text messages. But yeah, on the Zoom call here, I'm gonna lose this as soon as we get off the Zoom call. So I'll try to get to everyone. If I don't, message me again and remind me. Could you show us how an impermanent loss calculator works? Ken, no, not right now, and probably not in the next 2 sessions either. Only because I think you already asked me about this and I sent you a video to watch. Impermanent loss is something that people think they understand it, but they don't. And even when I explain it to them, they still don't understand it. And if you use an impermanent loss calculator, and I'm going to tell you this now, but I know you're going to go try to do it anyway. If you try to use an impermanent loss calculator, you will drive yourself nuts. Anyone who does, you'll drive yourself absolutely bonkers because all you're doing is looking backwards in time and going, oh, if I had made a different decision, I would have had a different outcome. And I'm going, duh. Like, you don't need a calculator to know if you made a different decision, you would have had a different outcome. It's just that an impermanent loss calculator puts numbers to it and it drives you nuts. And it's actually completely antithetical to the hedged approach that I've been teaching this whole week, meaning don't try to chase the highest possible upside. The only possible reason you or anyone would need an impermanent loss calculator is because you're trying to chase the maximum possible upside. So if anyone wants to do it, more power to you. I'm just telling you ahead of time, you'll drive yourself crazy, and the pursuit of maximum possible upside is in opposition to the hedged approach that I've been teaching throughout this whole segment. Okay. Having said all that, I know some of you are still going to try it. Humans being humans, right? And people like to do that. They like to, play around with stuff, even if it doesn't help them. But I would suggest that playing around too much with impermanent loss calculators is exactly the type of actions we talked about yesterday. Taking more action gets me better result, not always. So yeah, you can understand impermanent loss if you want to. In a nutshell, it's saying what would have happened if I held these two assets unpaired versus if I paired them and participated in yield farming. And the calculator will tell you, oh, in the completely arbitrary time frame that you chose, you would have done better if you held them unpaired. Or in the completely arbitrary time frame that you chose, you would have done better if you paired them up and harvested the yield. But that's the thing. We're looking forward, so we need a hedged play that mitigates risk rather than looking backward and driving ourselves nuts, kicking ourselves over the decisions that we would have, could have, should have made. Okay. So I'm not shy about the fact that playing around with those calculators, I think, is a really terrible idea. But Ken, you're more than welcome to. My assumption is that you're going to try to do it anyway, which is fine. Like, whatever. It's like I went down that rabbit hole at one point, and then as soon as I realized it's like completely ludicrous, I just stopped. So I'm not unsympathetic towards the desire to test them out and learn them. I just already know ahead of time what the outcome is going to be. All right. Thank you, everyone. Great session today. Like I said, tomorrow, Saturday, Sunday, we're going to be getting into tactics and tools. And again, message me if you're not getting the replays. I want to make sure everyone has access to that. And also, I'll just say ahead of time, like, please be patient because I'm getting literally like dozens and dozens of these kinds of requests every single day. And it is a lot of work to try to keep up with everything and make sure that everyone has what they need. So, all right. Have a great day. Have a great weekend, and I will see you all tomorrow.